1. Entity. Business entity means a specifically identifiable business enterprise like Super Bazaar, ITC Limited, etc. An accounting system is always devised for a specific business entity, also called accounting entity. 2. Transaction. Value between two or more entities. It can be a purchase of goods, receipt of money, payment to a creditor, incurring expenses, etc. It can be a cash transaction or a credit transaction. 3. Assets. An asset is any resource owned by an enterprise that is expected to provide future economic benefits. Assets can take many forms, including tangible items like machinery, furniture and vehicles, as well as intangible elements like patents, trademarks, and goodwill. In financial terms, assets are listed on a balance sheet. Assets can be classified into two categories. 1. Non-current assets and 2. Current assets. Non-current assets are also classified into 5 categories. 1. Fixed assets. 2. Non-current investment. 3. Deferred tax asset, net. 4. Long-term loans and advances and other non-current assets. Current assets are also classified into 1. Current investment. 2. Inventories. 3. Trade receivables. 4. Cash and cash equivalents. 5. Short-term loans and advances and 6. Other current assets. Here, the fixed asset also divided into 4, such as 1. Tangible assets. 2. Intangible assets. 3. Capital work in progress and 4. Intangible assets under development. 4. Liabilities. Liabilities are obligations that a business or individual must fulfill in the future, often arising from past transactions or events. In accounting, liabilities are typically classified into 2 main categories: current liabilities and long-term liabilities. The current liabilities are classified into 4 categories. 1. Long-term borrowings. 2. Deferred tax liabilities, net. 3. Other long-term liabilities and 4. Long-term provisions. The long-term liabilities are divided into 1. Short-term borrowings. 2. Trade payables. 3. Other current liabilities and 4. Short-term provisions. The next accounting term is 5. Capital. Amount invested by the owner in the firm is known as capital. It may be brought in the form of cash or assets by the owner for the business entity. Capital is an obligation and a claim on the assets of business. It is, therefore, shown as capital on the liabilities side of the balance sheet. 6. Sales. Sales are total revenues from goods or services sold or provided to customers. Sales may be cash sales or credit sales. 7. Revenues. These are the amounts of the business earned by selling its products or providing services to customers, called sales revenue. Other items of revenue common to many businesses are commission, interest, dividends, royalties, rent received, etc. Revenue is also called income. 8. Expenses. Costs incurred by a business in the process of earning revenue are known as expenses. Generally, expenses are measured by the cost of assets consumed or services used during an accounting period. The usual items of expenses are depreciation, rent, wages, salaries, interest, cost of heater, light and water, telephone, etc. 9. Expenditure. Spending money or incurring a liability for some benefit, service or property received is called expenditure. Purchase of goods, purchase of machinery, purchase of furniture, etc. are examples of expenditure. If the benefit of expenditure is exhausted within a year, it is treated as an revenue expenditure. The benefit of an expenditure lasts for more than a year, it is treated as an asset, also called capital expenditure, such as purchase of machinery, furniture, etc. 10. Profit. The excess of revenues of a period over its related expenses during an accounting year is profit. 11. Gain. A profit that arises from events or transactions which are incidental to business, such as sale of fixed assets, winning a court case, appreciation in the value of an asset. 12. Loss. The excess of expenses of a period over its related revenues is termed as loss. 13. Discount. Discount is the deduction in the price of the goods sold. It is offered in 2 ways. 1. Trade discount and 2. Cash discount. Offering deduction of agreed percentage of list price at the time selling goods is one way of giving discount. Such discount is called trade discount. It is generally offered by manufacturers to wholesalers and by wholesalers to retailers. After selling the goods on credit basis, the debtors may be given certain deduction in amount due in case if they pay the amount within the stipulated period or earlier. This deduction is given at the time of payment on the amount payable. Hence, it is called as cash discount. Cash discount acts as an incentive that encourages prompt payment by the debtors. 14. Voucher. The documentary evidence in support of a transaction is known as voucher. For example, if we buy goods for cash, we get cash memo. If we buy on credit, we get an invoice. When we make a payment, we get a receipt, and so on. 15. Drawings. Withdrawal of money and/or goods by the owner from the business for personal use is known as drawings. 16. Goods. It refers to the products in which the business unit is dealing, that is, in terms of it is buying and selling or producting and selling. The items that are purchased for use in the business are not called goods. For example, for a furniture dealer, purchase of chairs and tables is termed as goods, while for other it is furniture and is treated as an asset. Similarly, for a stationery merchant, stationery is goods, whereas for others it is an item of expense, not purchases. 17. Stock, inventory. Stock is a measure of something on hand, goods, spares and other items in a business. It is called stock in hand. In a trading concern, the stock in hand is unsold, as at the end of an accounting period is called closing stock, ending inventory. In a manufacturing, 1. Raw materials, 2. Semi-finished goods, work in process, and 3. Finished goods on hand on the closing date. 18. Purchases. Purchases are total amount of goods procured by a business on credit and on cash, for use or sale. 19. Debtors. Debtor refers to a person or entity that owes money to your business for goods or services sold on credit. A group of such individuals or entities is called sundry debtors. They may also be referred to as accounts receivable or trade receivables. 20. Creditors. Creditors are individuals or companies to whom you owe money for goods or services purchased on credit. A group of such individuals or entities is called sundry creditors. They may also be referred to as accounts payable or trade payables. Don't forget to like and subscribe.